Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 234 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week, we are deviating from our normal schedule to welcome Seth Golden on the show. Those of you who have been longtime listeners know that both Matt and I discuss Seth's research on the show quite frequently. Seth is a hedge fund consultant and a chief market strategist at Phenom Group. He is a 17-year veteran of the consumer packaged goods and retail industries. He's also worked for some of the largest retailers in North America, including Target and Bed Bath & Beyond, which my wife supports weekly, it seems like. Seth has been a independent trader and economist since 2000, gradually improving his trading strategies and understanding of the global economy. In 2012, Seth grew his equity market participation and basis of knowledge with careful studies and participation in the VIX complex. He's most widely known for coining the thesis desensitization of volatility, which we'll get into. Seth has written and published over 500 articles since 2012. So, Seth, welcome to the show.
Thank you. Thank you very much, Mark. Makes me sound like I know what I'm going to be talking about today.
Yeah, that's all of us, right? Whenever we hear our own bios get read. But as always, we're just going to quickly run through the month to date and year to date, which obviously here in January is the same performance of the major market indices that we track. And this data is from YCharts and as of January 10th. S&P 500 index up 0.3% for the year after a slightly rocky start. Dow Jones Industrial Average is flat on the year. The NASDAQ Composite Index down 0.3%. The small cap Russell 2000 Index down 2.8% on the year. And the Vanguard All World ex United States ETF down 1.4% so far this year. 3-month Treasury rate at 5.46%. The 2-year Treasury rate at 4.37%. And the 10-year rate at 4.04%. So kind of just to start, Seth, can you talk just a little bit about yourself, your background, and, how you got started in the industry?
Yeah, favorite thing to do is one of my favorite pastimes is to talk about myself. If we go back far enough, the 5th grade, I had this project, for my social studies class, and it was, each student had to pick a stock and follow it. And, back then, 20 years ago, 5th grade, it's a little bit longer back, but, back then you could only get your quotes, your tickers in the daily newspaper. And so that's what I would do. I would check it. It was Disney, right? I mean, what do you know as a kid, right?
Yeah.
Disney. So,
of course.
And, it happened to be a good pick, and I had the best stock pick in the class of 5th graders at the time, not knowing much of anything other than,
right.
Do I like going to Disney? Do I watch Disney movies? But, as I got older, it was always in the back of my mind. My dad was a stockbroker. And while he was running his day-to-day business, he got his brokerage license and whatnot. And this is in Miami where we lived. And I remember 1987 going to his high-rise office with my mother because he wasn't coming home. Certain nights he'd be out just really late, so we'd go to his high-rise office. I think this was down in Key Biscayne area. And, he was always just super stressed out. And you don't realize it in real time as a kid. But thinking back on it, the dates, I was like, oh, 1987. Okay, got it. So it was always something in the background for me. Went through college. I actually got my first degree in English education to be a teacher. But when the first opportunity came to, trade my own account was 1999, and you had all of these electronic trading platforms surface, like, E-Trade and TD Ameritrade, and mine was Scottrade. And so I opened up my own brokerage account with some money that my grandmother had given me as part of my college tuition that never got spent. So I had this leftover sum I just put into this Scottrade account. And I knew Starbucks, right? 1999. I'm just trying this out again. I have my own money. I can actually do this. So it was Starbucks. And you're young, you don't know any better. Fortunately, I didn't get caught up in all of the .com stuff. And I had the, maybe the intuition to just trade what you know. And so I was just trying to trade Starbucks while working, a 9 to 5, or in the morning, I'd put my order out there for Starbucks, and I was just hoping to make $100 a day, maybe a few $100 a week. It was going pretty well. I decided to start spreadsheeting. Okay, the daily open, the daily close. When you used to have to do it by hand, right?
Right.
And I was doing pretty well, but you'll always recognize, okay, I'm leaving a lot of money on the table doing this day trading stuff. And one day I got lucky, and I wake up and there's a huge spike in the stock, like $4 in the pre-market, not knowing anything about earnings seasons and things. And I was just like, okay, I took my profits then. But, through education, I started to understand, okay, day trading is only going to get you so far. So let's try some swing trading. I graduated to swing trading, and then decided, okay, I need to know what earnings are. I've got to understand what EPS is, revenues, gross margins, and all this stuff. So I started reading quarterly transcripts, and I started to broaden my wait a second, I work for Target. Why don't I know? Why am I not buying Target shares? I know retail. Why do I not own Walmart? And, so things start, manifesting in that direction, to where I'm having a better understanding of quarterly earnings and the trends of, the stocks and things of that nature. And so before I knew it, I had my second degree, and I decided, okay, I've been in retail for 20 years, maybe. My passion, I'm really developing, I want to do something else. And Target was great to me, paid for my advanced education, for which they thought I was going to go to Minnesota and be with their law department, their legal department. And I decided to go off on my own. And my good friends were starting their own research boutique firm, doing sell-side research, trying to sell to institutions, RIA shops, hedge funds, and so forth. So I was doing full-fledged, macro, top, bottoms up research on individual stocks, as well as the broader market. And this was probably by 2011. And the more you do that, the more that you get into all of those nuances and the weeds and the stuff that Warren Buffett rightfully says, stay away from, because it'll drive you crazy. But at the same time, the level of education and understanding you have for stocks, markets, and the economy, it's just a treasure trove. You learn to respect what Warren Buffett says. Do you have great stuff that you can talk at parties and whatnot and make yourself sound smart? Absolutely. Is it practical? To a lesser degree, right? I mean, if we just pick blue chip stocks like JP Morgan and Apple, like, do you really have to read their quarterly reports? You get a lot of it on the media networks and whatnot, and you look at what the stock price has done, and you look at what's in your hand most of the time, right? So I did a lot of boutique research. We did very well. Our firm got bought out. And I've been investing on my own. I created the Golden Capital portfolio in 2012. Just a partner We all put our money into the portfolio that I would manage. I would do the buying and the selling and what have you. And we've grown that participation over the years as well. So managing a multi-million-dollar portfolio up to this time, and my goal has always been to kind of put a bow on this, to at least meet the market's performance annually. And I've been successful in that, above and beyond. I mean, generally, I beat the market because I stick with the market. I'm not trying to outsmart the market. I hold myself in high esteem, just not that high esteem.
Right.
So
right.
I've learned over the years that the market we can make it quite simple for ourselves as investors, or we can make it extremely difficult. The more stock picking you're doing, it's probably going to be more difficult. The more ETF and index instruments that are in your portfolio, you're probably going to do better. And if you can lower the volume on that CNBC or Bloomberg in the background, you'll probably do better as well. So
yeah, well, no, that's interesting. Thanks for the deep dive into kind of your background. And it's funny, Disney, that was actually one of mine as well, but didn't turn out too well. So I graduated from the University of Dayton, and they have what's called the Davis Center there, and they piece off a portion of the university's endowment for the students to manage in this organization. And the stock I pitched was Disney. And, was super high on it, practiced my pitch to the organization a million times, it seemed, and thought it went really well. And it got accepted into the portfolio, but just did horribly. I think it was like 2015 or 2016 when that happened. And that's when Disney started going sideways as the market continued to go up. So my experience with Disney was not as good as yours in fifth grade, unfortunately.
I think that was the Pixar jinx, right?
Yeah.
When they acquired Pixar.
I think so. And then they had, Iger left, and now he's back, and so they got a lot of stuff going on. But I would say it's getting time for Disney to start to do something
attractive.
here. It's very attractive. So, Matt, I know you had a couple questions for Seth. If you want to go ahead.
Yeah, Seth. First of all, super pumped to have you on the podcast. Your content on X is just absolutely amazing. So for our listeners and viewers, his handle is @SethCL. Just absolutely consistently good content. So I know a lot of your work, Seth, is centered around the VIX and volatility. So in your own words, for our listeners and viewers, can you explain what the VIX is and why you decided to focus on it so much in your work, sir?
Well, how that part of my educational journey started was we had a client when I was doing the research for Capital Ladder Advisor Group, and we so impressed with what we were doing in the consumer packaged goods space. I was covering your Walmarts, your Targets, your Best Buys, your Bed Bath & Beyonds, blah, blah, blah. And so when the clients came to me with an S1, the prospectus for the Pro Shares ticker symbol UVXY. Now, to this point, I knew that the VIX was a 30-day implied measure of forward volatility. That's it, right? It's calculated off of the S&P 500's options market. That's about all I knew. If it's going up, more than likely 85% of the time, the S&P 500 is going down. And if the VIX is going down, 85% of the time, S&P 500 is going up. That was my basis of knowledge. Seth, I can't figure this out. I want you to read it and give me your feedback on it. So I'm reading the S1 filing, and I'm like, short dated, VIX futures, priced off options. And I'm just like, by the second paragraph, I'm like, there's no way. What I know from this, here's my feedback. Stay away from it. If I can't figure it out, you need someone who's dedicated and knows, that much more about the options market and futures market than do I. And he's like, I really want you to take, because I think this is quite compelling. All right, let me sit down. Like, let me not just say, okay, I read the first two and I didn't give it its due attention and kind of fluff it off. All right, let me really do it. But I need time. I'll pay you for your time, Seth. That's never been in question. Okay, all right, now we're talking. So I read it further, and I get to the end, and I'm like, well, if you're not supposed to hold this overnight and blah blah, all right, whatever. I don't understand the futures and the pricing and the arbitrage involved in this particular instrument. So I decide, okay, I need a subcontractor. Who can I find that actually specializes in the volatility complex that can educate me so I can educate my client? So I hook up with this other firm, and they go through from A to Z with me over about a month. And my clients he's like, Seth, anything? And I'm like, I'm getting deeper.
There.
Give me some time. Yeah. And so finally I started feeling like I have a good understanding of how the derivative nature of the volatility complex. But I want to put it into practice. What I'm reading and what he's informing me, and these are brand new instruments. These volatility exchange traded products, whether they're in an exchange traded fund or an exchange traded note, I'm starting out, but they're new. So there's not a lot out there in the way of studies. There's really trial and error. So what are we going to do? We're going to trial and error this thing. So I dedicated about $100,000 to start trading the UVXY and see what came of it. So here I am. We've got a good stock market, and volatility is pretty tame. And these are a derivative of the VIX. It's a 4th degree remove, but it's still derivative. And okay, so I'm going to buy it because I think the market is due for a correction, and I think the VIX should elevate. I buy it. The market starts to correct. The VIX starts to elevate, and UVXY still going down. Like, what the heck? All right, well, maybe it's just something in the rebalancing nature of the product. Let me add a little bit more. So now I'm increasing my position size. Market's still correcting. This is the European debt crisis time frame. And
Greece is in the headline every day.
Exactly. And I'm like, what the heck? All right. So my dollar cost average, I'm still dollar cost averaging. And then it starts to elevate and whatnot, but it's not doing what the VIX is doing. The VIX is really starting to move, but my UVXY is going, it's like a snail's pace. And okay, wait, contango. I remember him telling me about contango and all this different language around the volatility complex. So let me go look at this stuff, and I'm like, I'm screwed here. Well, I mean, forgive me.
Yeah.
This is not going to work. There's huge contango. No matter what the VIX does, I'm not going to make any money on the long side here. So that's when it started to dawn on me as I read a little more, go back to my coach, and I'm like, is this true? If X, then Y? He's like, yeah, that's what I was trying to explain to you, Seth. I'm like, okay, I'm starting to get it. So if I short this product, if I short UVXY, and I give myself enough duration or liquidity in the position, I should make money based on this contango mathematics, right?
And your words, just 20 seconds. Can you explain contango for listeners, Seth?
So contango is essentially when the front-dated future contracts are priced lower than the back-dated future contract. So what an asset manager, the asset manager of this portfolio, of UVXY, of the ProShares product, is doing on a daily basis is he's rebalancing the instrument, the assets under management. Every day, that authorized personnel is what they're called, has to sell the front-dated futures contracts, because futures they expire. They don't live forever, right? They have an expiration date. So you got to get rid of the ones that are closest to expiry and buy the backdated contract. So you're selling low and you're buying high. That's contango. The opposite of that is backwardation, where you're buying high and selling lower. And that's where, you can get in trouble from the short side. So if I'm short UVXY, but we're in backwardation, the term structure of these futures contracts are in backwardation, now it's working against that short volatility position. So to kind of make a long story short here, that's how I got involved it was basically a client wanting to better understand this new product from ProShares. And it took me down this, this journey.
Rabbit hole.
Yeah. To basically when you understand volatility, the volatility of markets and the nature of volatility in markets, you get a better understanding of how to invest well. I think I had mentioned earlier, stay in the market. We just had a bear market, which literally had the lowest median VIX during a bear market cycle in history.
That's a bold stat. That's a big stat. Big stat.
Right. The desensitization of volatility. When you understand volatility, you understand the S&P 500 in the sense that volatility has no probability of existing in a perpetual uptrend, right? I mean, if you just think about it logically, nobody's going to put their money into a market that is moving 5 and 6 and 7% a day, right? I mean, we saw that back during COVID, right? And we had limit down days on a couple occasions where there were the rumblings of maybe we close the markets for a week. Right?
Yeah, those weren't fun.
Right. Nobody will put their money into that situation. So there's no probability that, and people don't like using such generalizations or absolutes in the investing sphere, but there's no probability that exists whereby volatility can persistently trend higher forever. And if you accept that as an investing principle, you understand that the S&P 500 has the opposite. It has no probability of going down over time and only the probability of going up over time, either structurally or because of earnings growth. One of the two is going to make that happen on that S&P 500 path over time.
Interesting viewpoints. I love it. One comment that I have is, when people see these ETFs and these ETNs that you discussed, they got to remember that those are trying to replicate a specific index. You're not, and there's no guarantee of success that they're going to be able to do that, and or the performance is going to be equal even when you take out the expenses. So you gave a really good illustration of that, Seth, in addition to you providing, light behind volatility and how it affects the market. Awesome. Mark, you want to go next, sir?
Yeah, I want to throw up a chart for the people watching on YouTube. This will also be in our show notes, but this was a tweet, Seth, from you back on December 29th of last year. And you tweeted, remember, the small cap performance is just a rental with the option to buy. Outperformance after peak interest rates historically lasts only 6 months, then it underperforms every other asset class. So can you kind of explain this graphic that's on the YouTube video right now for listeners?
Sure. Essentially, if the Fed is going to be lowering rates, historically, out of the gate, and you tend to price that early, right? The market tends to be a forward discounting mechanism. Small caps tend to do the best because A, they have the most beta composition because they are small, and B, because, well, they're very interest rate sensitive. And so if we're talking about lowering interest rates, the sentiment behind the most interest rate sensitive areas of the market will tend to outperform near term. And once that's all priced in and the Fed is expected to get to that comfortable place with the Fed funds rate, that outperformance fades. And then you get back to, okay, where's the earnings growth? Well, it's generally in large cap growth. Okay, so that starts to outperform. So from that perspective, I've been of the opinion and remain of that opinion that small caps are a good rental, but I don't want to be in them long term. They're small caps for a reason. It's because they don't have the capital, they don't have the earnings, and that's what it all comes down to. Where's the greatest earnings growth going to come from is usually where the capital flows, even if not in the immediacy, over the long term. So I would be, the other thing that, not specifically to that tweet, but in talking to my clients, I've emphasized that never before in history, right? The small cap go back to, I think, 1986, 1987 is when the index was created. Never in the history of the small cap index has it been in bear market territory 3 consecutive years. So we just went through 2022 and 2023, where in both of those years, it expressed bear market territory. What's the probability? I want to lean into the highest probabilities. So maybe it doesn't outperform for the whole of the year, small caps, but there's always that percentage of a person's portfolio that says, okay, I'm not going to outperform, but where can I know based on the data, I'm going to get a return on that capital regardless? And the data says that, historically, you've never had three bear market expressions in consecutive years for small caps. So I was talking to that with our clients in October when small caps were making another low. And I said, based on the data, now's when you buy. And lo and behold, rocket ship to the upside.
Yeah, and to add fuel to the fire, it was like perfect timing because like on a seasonality basis, if you just look at a calendar year, like the fall through the end of the year is when small caps typically outperform. So you combine that with, what you're talking about with the Fed having peak interest rates, it was like, okay, small caps were like, they were like up like 3% for in the middle of the year, then like 5%, then down to like negative after the sell-off in late summer and early fall. And then they ended up the year like up like 16 or 17%, right? So it was kind of a wacky year for small caps. But we're kind of in the same boat with you there.
Yeah, you nailed that, Seth. And you look at the relative performance of large to small the last couple of years and how dramatic that was. That lines up well with your research. Let's just keep adding to this. I think your viewpoints are just very intriguing, and I love them. So on January 6th, you had a tweet, and I still love that. We all three of us call them tweets for the record. You had a tweet about your 2024 outlook, and I think it was kind of a summarization, but let's talk about it. You said, 1, fourth bear market in 6 years, which has never happened before. 2, double-digit gains for the 5th time in 6 years, which has only happened 2 times since 1930. You posted that on January 6th. Can you go a little deeper for us and just tell us what you're thinking here?
So what I was thinking is these are your extremes, right? Neither of these are high probability outcomes.
Yes.
I tend to think very quantitatively. As an investor, I guess the greatest metaphor is, if you're going to go to Vegas, do you want to stack the deck in your favor or not? So I look at investing the same way. What are my probabilities based on this set of data? So again, we've never had in a 6-year period 4 bear markets. That's never happened before. So we can, quantitatively suggest that more than likely, we're not going to have a bear market in 2024.
And there's been a lot of scary times over the last, say, 100 years. There's been a lot of scary times.
And yet, we still have not managed that feat of strength, 4 bear markets in 6 years. So on the opposite, end of that is, okay, is this going to be another double-digit year? Another double-digit year of returns? And, based on what is it, 5-year time horizon, having 4 double-digit return years in 5 years, that's very rare also. So really what I was trying to project there is, if you look at the 2 extremes, we're probably going to thread the needle, right? We're probably going to have something in the middle there for everybody to enjoy. Mm-hmm. So that was, I don't have a verified account, so I can only fit so many characters in my post. But that was the intention. I want people to think about, here's the extremes. More than likely, you're not going to get either of those because they're very low probabilities. It's going to be something in the middle, more likely than not.
Right.
Well said, Seth.
Which I think is a very logical way to look at, outlooks, or if you want to call them predictions. And, listeners that have, listened to our show for quite some time know that I am very heavily against outlooks and predictions, from analysts or economists, because 99% of the time they're wrong.
Yeah. I do it really just for the sake of testing myself.
Yeah.
I do it for our clients. I give a price target and whatnot, but really it's, how I'm trying to test myself. What are my touch points with the whole macro market picture based on this outlook or this?
But rather than opinion, you're basing them on a lot of historical data,
right. Yep.
and you're applying it to today's situation, which
exactly.
I think is a little bit different.
100%.
Yeah. So kind of dovetailing off of that, Seth, it sounds like you use fundamentals, technicals, economic data points. You use all of that when you go into creating your thesis and your positioning and your portfolios.
Yeah, I believe that, the best investors I've come across, the best hedge fund managers that I've consulted with over the years, they use it, the three, what I believe are the best three disciplines: quantitative analysis, fundamental analysis, and technical analysis, and or have, within their firm, those disciplines covered to, give them feedback and what have you. So I tend to use all three of those in earnest. Fundamentals I've been doing for, 12, 13 years. That's where my comfort zone is. I got into technical analysis and appreciating the value of technical analysis probably about 7 years ago. So that, and it's only been about 5, 6 years that I've dove into the quantitative side. And to be honest, that's where I'm finding the greatest passion, is the quantitative studies and data, because, where technicians will say, well, it's black and white. There's no fundamental, garbage that can lend bias, like, well, the CEO said this, and, well, his sentiment, his tenor on the conference call. At the same time, even with technical analysis, you're bringing a degree of, I see the lines this way, and I do know Apple. So even though the technicals say this, there's some degree of knowledge about that stock and or company that is pushing bias into your calculation, so to speak. Whereas quantitative analysis, it very much is. You can't manipulate it. It's historical data. It happened, and this is the print. It's like a diagnostic. You can't go back in time. If you're a mechanic and say, well, let me go back in time and tell the guy to put oil in his engine. Like, that doesn't work. And it's the same thing with quantitative net. There's nothing you can put in there. You either go with the highest probabilities, or, flat out, you're injecting your own persona and bias into this. So
yeah, and a perfect example of that is
Seth.
it's an election year, right?
Mm-hmm.
So
yep. Election years. There's a lot of data about election years.
A lot of
which president.
Yeah, which I think would surprise a lot of people, right? Because they think, if a Democrat's in the White House or Republicans in the White House, the market's good or the market's bad, and then we give them the data, and it's like, actually, it's kind of the opposite. So
yeah, if you want to make enemies at a party, you give them facts about, who's, when the market does better.
Yeah, exactly. Hey, I'd rather make enemies at a party and be right with clients' portfolios, right?
That's right.
When it comes to politics, I think that's a root of evil for a lot of investors too. They invest their politics, and it's just never been a good idea.
We see it all the time on the front line, Seth. So I got another one. Let's kind of make a transition. I know you sent over a graphic to us, what you kind of coined the mid-decade bulge. Jenna's going to put up this this illustration for our YouTube viewers so they can see the chart. This will be in our show notes for our traditional podcast listeners. I would encourage them to take a peek at this. Will you, first of all, walk through the data set and then explain what they're looking at, Seth?
Absolutely. So giving credit where credit is due, this study actually came from Jay Capil at the Sentiment Trader, and
They do phenomenal work.
Yeah, 100%. I just stumbled upon it. Again, a client sent it to me, and I was like, looking at the graphic, I was like, wow. And it just forces you to realize, look, the longer you stay with the market, time is your friend. Again, going another famous quote from Warren Buffett, make time your best friend. Yeah. And what the chart shows is the mid-decade bulge essentially starts at September, the end of September of a decennial year, or a year that ends in 2, and it runs through the year. I think it's the end of the first quarter of a year that ends in 6. So it's basically a 4-year cycle that ends in the middle of the decade, hence the mid-decade bulge. And when you go all the way back to the 1920s, the only time that particular set of years or cycle has delivered a negative return was, I believe, in the 1970s. That's it. And the returns are pretty strong. I mean, high double digits, even triple digits on a couple of those mid-decade bulges, but only one in the 1970s delivered a negative return. So we are in that period right now. It started September, the end of September 2022. Lo and behold, we bottomed in October of 2022, and it's been off to the races. We're still in that cycle, which is why I've often encouraged, our clients, hey, if you get a pullback, again, if you think longer term and you think about this mid-cycle bulge,
you're underallocated to risk assets.
Exactly. Yeah, you're underallocated. When you can get more exposure, the data says get more exposed.
Yeah.
Love the thought process. Mark?
Yeah. No, it was great. No, I love seeing that. I think if you're just listening to this, go ahead and check out our show notes and take a peek at this, because the returns are pretty strong. Kind of wrapping up here, Seth, just a final question for you. What services do you offer to your clients through your company, and who is your target client, and then at the very end, where can listeners go to learn more about you or follow your work?
Yeah, so our first firm got bought out back in 2015, and unfortunately we had a non-compete, so I couldn't open another firm and website. But as soon as we could, we did, and we started Phenom Group, Finom Group.com. We started that the day we opened, the day after Christmas in 2017. So PhenomGroup.com, what we do and what we offer, we cater to all walks of the investing classes, whether it's institutions or retail, RIA shops. We white paper as well. But I offer a macro market research report 3 times a month. Give myself a weekend off, They go out Sundays. We have subscription levels for investors, or just those folks who want that high level, high quality research that encompasses your technicals on the markets, your fundamentals on the economy, and your quantitative studies. We put all 3 of those disciplines into the macro market research report 3 times a month. We cater also to investors and traders that are actively managing portfolios day in and day out. So we have our premium level subscription gives you the opportunity to mirror what I'm doing with the Golden Capital portfolio. So you get my trade alerts, my investing ideas. You get to into our trading room, which operates 8 o'clock to 4 o'clock, 8:15 to 4 o'clock when the closing bell is on Wall Street. So you get my commentary throughout the day. You get the education, throughout the trading day. You don't have to feel like you're alone. There are far too many, quote unquote, lone wolf traders that might last a year to 2 years in the market before they're ushered out, because they think lone wolf trading is, how they're going to succeed. So you get access to myself and all of our other members who are, quite sophisticated. I mean, we have, folks that trade the prop desk at Goldman Sachs, in our trading room, former Credit Suisse, traders and what have you, they're in our trading room, UBS. So we have a lot of high, level clientele, and I do white paper for like RIA offices, as well as some popular institutions, which I'm not supposed to mention. So
yeah. Great. Well, again, Seth, thank you very much for coming on the show. We really value your work and appreciate, all you do for our industry. We're, like Matt said earlier, we're very data dependent here at Jessup Wealth Management. And we like to use, history as our guide and data as our guide forward, rather than just our opinions on things. So appreciate everything you do, and thanks for coming on.
Thank you. Thank you, gentlemen.
Absolutely. You're a rock star, Seth.
Appreciate it.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.